At the end of this video, you should be able to observe and select a good cup and handle pattern to trade. How often do you trade the cup and handle pattern? Here, we will critically analyze the behavior of this pattern and the reason behind its movement. The formation of this pattern is a consolidation period for market prices. So, when price breaks the handle, it signals a continuation of price movement, and the duration for the formation of this pattern rests on the time frame and the momentum of price movement. One thing to note is that it's a very profitable pattern to trade if prices move to your predicted direction. In this chart, market prices were trending down before the formation of this pattern. This is a U-shaped cup, which means that there was an equal buying and selling pressure between the bulls and bears at some point. Here is the handle. Let's highlight this. This pattern is a bullish continuation pattern, and this simply means that at the close of this pattern, prices are expected to continue going higher. A round-shaped cup pattern. For this pattern to be valid, the sides should be equal or very close in height. The formation started here. The handle is the most important part of this pattern, because this determines what to expect from the pattern. This pattern formed a small handle, and the handle is the most important part of this pattern, because this determines what to expect from the pattern. This bullish candlestick broke the handle here. Traders at that moment would have expected prices to go higher, but that didn't happen. If you traded on this market with this bullish breakout, you would have made losses. Below the bullish candle will definitely be the level of most traders' stop loss, and the profit target will be the height of this pattern, or somewhere below the highs at this level. Let's highlight this. When you buy here, you will have the stop level here, and your target somewhere at this level. A lot of traders must have predicted the movement of prices this way. I will tell you a fact: when it's come to financial markets, prices can go anywhere. This is why it's important to have a risk management rule governing the steps you take as a trader. So far, this handle doesn't go below this pattern. It's still valid for this pattern. After the false breakout, a long bearish candlestick closed below the handle, and this signified strong presence of the sellers. This means that the bears have taken over the market at that point, and this could mean that prices are likely to continue lower. Prices will never go your way all the time. This is due to certain factors that influence the market. This is why you must pay close attention to price actions. Why didn't prices go the way you predicted? Before we take a look at what happened at lower time frames, go to the comment section and share your thoughts, including other aspects of the financial market. Let's take a look at 1 hour time frame. This is why it's always important to zoom out your chart in order to understand price movements better. This is the handle. The formation of this pattern also cut across lower time frames, but it's easier to detect when you go higher in time, except you zoom out. A good scalper will definitely get something out of this breakout. This is the benefit when you make entry positions using lower time frames. The close of this candlestick was a good entry level. A good scalper will take advantage of this pips. Always have different target levels in the market. This will enable you earn even if prices eventually goes against you.